Thank you. Hi, my name is Danny Bloomstein. I'm a director here at Juniper Square. I'm based in New York City. We are an investor portal provider. We're also a fund administrator. So our technology stores investor data. It allows sponsors to create data rooms and portals white labeled and reporting and help calculate distributions and capital calls and all that. So I'll let the panel introduce themselves.
Go down. Nick Russell from Tuckerman Capital. We're a small fund based in New Hampshire. We're investing our sixth fund. And over the last 20 years, exclusively have invested in support of and in partnership with independent sponsor partners.
Judith Ottensasser, Rock Mountain Capital. We're a fairly new independent sponsor, private equity focused on consumer products, healthcare services, and some technology.
Brad Batten, Broad Tree Partners. We're a control lower middle market sponsor, and we started as a traditional independent sponsor and have kind of evolved our model to be a bit of a hybrid of that now.
So definitely, if you guys have questions, write them down. We'll try to have some time at the end here. So the panel's on how to put your best foot forward in front of capital providers. A lot of these questions I'll ask everyone to answer, and we'll go kind of down the row. So let's just start with how does your firm find new capital providers? And maybe if you have an example of how you've met and brought in a most recent one, share that with the group.
Sure. So we're on the other side of that. And I think because we've been investing with independent sponsors over the last 20 years, we haven't done a lot of like outbound marketing stuff, but I think events like this have certainly been fruitful as a forum and medium to meet folks for us. And I don't know, maybe these guys have better answers to the question. We philosophically at Tuckerman, our model is all about partnering. So part of that sort of throughout our model is all about sort of being open, and you want people to call you. So my best advice would be just like figure out who some of the capital providers are and call them. And if they're open to taking your call and having a conversation that may be indicative of, how they run their business and whether they'd be a good partner for you.
I mean, for us, we're fairly lean. We're only 5 professionals right now. And our historical network has been the best source of all of our capital. We come from a variety of institutional firms, and based on deals that we've done, places, you never know where. When I was an analyst at an investment bank, my fellow analyst is now a large fund that co-invests with capital. So keeping up with your network, reconnecting with people, figuring out where they are, that first phone call is sometimes a little uncomfortable, but getting together with people and networking. And then once you've done one deal, often you go back to the next one, and there are referrals always that come with that. So building your reputation along the way and making sure you don't burn any bridges is definitely, I find, the best way to connect with capital.
Yeah, I would agree with all of those comments. I think what's been most successful for us is referrals. Our existing investors are fantastic about referring us to friends, partners, et cetera. And I think a lot of our investors like to partner together with other like-minded investors. And so they're in a lot of same deals together. They know a lot of same sponsors. And so they're great at making those types of introductions. The other piece that I would say is we strive to be relational instead of transactional. And so we're big on having touch points before we have opportunities to share. And so we like to kind of reach out and introduce ourselves before it's, hey, here's a deal you want to invest in it.
I mean, the other thing I'll say is these relationships aren't instantaneous. Just because you have one meeting, it's not going to happen. You'd be surprised how 18 months down the road or 2 years later, you go back and reconnect, and having those constant reconnections with people often brings up something.
Is that would you say that's almost like an average timeline? Like you get introduced to a new capital provider, they're going to talk to you about maybe recent deals, and it may be 12, 18, 24, 36 months down the road before they come into a deal?
I mean, I'd say it varies a lot. We've had people, the first conversation with them was about a deal and they invested in that deal. We've had people who we talked to for 5 years before they finally invested with us. So I'd say it varies a lot.
Similarly, it's usually fairly unlikely that we're going to back an independent sponsor who we've never met or heard of, who calls, even if the deal is compelling. But we really cherish those, talking about a sort of a live deal as an opportunity to understand how those potential partners think and what they do. So I think my advice to folks in that position is to sort of utilize those fundraising calls, even the ones that result in hopefully a quick no, not a long no, as opportunities to build relationships.
To that point, how do capital providers evaluate sponsors? What are the common and the obvious questions and evaluations that you run? And then what advice or maybe avenues do they not often go down that you would recommend capital providers evaluate about a sponsor?
For us at Tucker, I can speak to our process at Tuckerman. I think we are certainly deal first, again, as a fund-based strategy that's invested over several decades now with partners, usually as the largest investor in the group, if not the only equity investor alongside that independent sponsor. We want to understand the deal first. There are certain criteria we look for. I won't belabor those in this panel, but the partner is actually really important. And I think there's not the easiest thing to point to. It's not about a pedigree or somebody who's done X deal or had some kind of crazy outcome on some other deal. Those things don't really matter to us. But folks who are able to articulate an investment thesis and articulate the opportunity, how we're going to make money together, as well as the risks and what you need to be right about upfront. And it sounds like sort of motherhood and apple pie, but like it's actually relatively rare that folks show up selling a deal and are upfront about here's the things that we're concerned about that we're working through diligence on. And that's usually a really good signal for us.
Would it be fair to say that having full and ample transparency up front would differentiate a sponsor positively?
I'm not sure what that means, full and ample transparency. I think intellectual honesty about the opportunity and the underwriting and the thought process around that thesis. Again, not just what can we do with it to make money, but what are the things we need to mitigate? What are the things that make us worried about it that we want to get comfort with? Because in that early evaluation process where we're saying, is this something we want to put our resources against? Is this a partner that we want to get, sort of commit resources and take risk with? The hardest part of that for Tuckerman or for the capital provider is getting alignment on the key issues. Because if you don't have alignment on those, maybe the deal happens, maybe it doesn't, but assume it doesn't, and you just had a difference of opinion on a risk factor, it just reflects really poorly on you as the capital provider. Like that's not a reference that works well. So having alignment on what those factors are upfront and saying these are the things collectively we're going to go try to figure out. If the story holds, the deal's going to get done. If it falls apart, everyone's sort of in agreement, like we're not going to move forward. But I think that's one of the nuanced aspects. So again, having partners who sort of put themselves in our shoes as the largest equity risk taker in a deal and sort of, surface those issues rather than trying to sort of like talk around them or just sort of shoot for the free option. That's again, less frequent than you'd hope, but it's quite refreshing when it shows up. So maybe that is, ample transparency.
Well, and to add to that also what we found, and this goes back to the last question about building relationships and forming partnerships, oftentimes the deal timeline is pretty quick. So if you have, a 60-day exclusivity or a 90-day exclusivity, you want to move quickly. In that time frame, things change and evolve. And we found our partners with our capital sources are the ones where we say to people up front, we got this deal, we're working through the issues, this is how we're going through due diligence and making sure that people have the information when it's available. And it's okay always to say, we're not really sure what this means. But knowing that you have that short timeline, building the relationship beforehand is critical.
Does your firm tend to build syndicates? We didn't talk about this too much on the prep call, but I think some of the answers to these questions are a little bit, again, thematically similar, but a little bit different depending on what you're trying to achieve and how you're trying to pull something together, because I think for syndicate building, which can be harder, but also in some respects feels less risky, that group of investors are going to be looking at you to sort of run every part of the process. And they're essentially going to upfront are probably going to ask, like, how much are you guys investing? Which is also important for us, but less so.
Right.
So it's just a bit of a different dynamic, sort of going with a
I mean,
single
for us, it
partner.
depends on the size of the deal.
Yep.
So we have about 50 different investors that back our deals. So if that's what you mean by syndicates, yeah.
Yeah,
They
group-
don't all
group-
But not
participate in
each
every
deal,
deal,
right.
but yeah. The only other thing that I would add on this topic, and kind of going to Nick's point, like, there are no perfect deals, probably period, and definitely not in this segment of the market. And so, like, to gloss over the risks would, I think, raise questions. And so I think, as Nick said, like, it's important, like, transparency is of the utmost importance, and every capital provider knows that the deal's not perfect. It's going to have some hair somewhere. So trying to spin it as if it doesn't have hair is not going to reflect well.
Brad, let's start with you on this. Can you touch on, over recent years, how your reporting styles and cadences and the way in which you communicate with capital providers has evolved?
Yeah, I think a lot of it is a function of, to be honest, like, our maturity as a firm. And as we've been able to staff up, we now have 14 people on our team, which includes a CFO and a controller. And so that gives us a significantly different ability to deliver more sophisticated, more timely reports than when we first started, and it was just 3 partners. So I'd say that's the big thing. One thing that I would say is, again, transparency is of the utmost importance. Our investors expect full transparency. They expect to hear the good, the bad. And kind of a funny anecdote, we put together a holistic scorecard for our investors, which allows them to see which deals they're in, what the mark to market is, and kind of how their portfolio collectively is performing. And across our 12 deals, we've got a variety of different cap tables. So as you can imagine, that's a pretty big effort. And we completed that after we did all of our Portco audits, and we were really proud of ourselves. We delivered it, and this is probably in June or early July. And all of the feedback was, these numbers are stale. Like, the valuations were as of 12/31, and we're like, oh man, like, and I get it. Like, people want to see as live and in real time as possible. And so it was just a reminder to us that, yes, we did a good job, and they appreciated that, but, like, there's always room to improve and kind of continuously improve.
I've been in this industry working in various firms or funds, various sizes. I would say 20 years ago, most of our communication was through our administrator, and really just performance-based. You know, you'd have your quarterly letter, but in terms of the statistics and the numbers and the deal performance, that was done through the administrator. That connection has completely changed over 20 years. Now, equity partners are expecting constant communication. I find that getting ahead of things and presenting things in a way that you want, that is meaningful to you, is easier than waiting for someone to ask the question. Getting ahead of it, you can always tweak a response or customize a certain response. But we've also found that having the same predictable type of information across deal flow, especially when you have partners who are repeat customers, so that you know what you're presenting to people, how you're presenting it, is definitely helpful. I think 20 years ago, people were like, ugh, I need to provide this to, you know, check a box, especially in the fund-to-fund world. But now, as investors are more sophisticated, in particular, you know, the family office used to be the dumb LP money. Now they're way more sophisticated, have their own systems in place. So having that constant communication is important. Not to jump on the Juniper Square bandwagon, we're actually a customer. Having a CRM system where you have all of the information for your investors and being able to communicate with them, and having the investors be able to self-service themselves through a portal definitely helps, and helps you maintain that communication while having a lean team. You know, to provide this without some sort of robust CRM system would almost be impossible.
I would also say our investors value consistency. And so consistency across the reporting in terms of what they expect to see, but also even, the formatting and how it's presented. And if they're invested in 8 of our 12 portfolio companies, they want all 8 reports to look, similar and to have similar content.
Presumably with programmatic quantified KPIs, maybe just EBITDA and revenue, gross margin, something like that, reported on a consistent ongoing basis with a little bit of color. Yeah. That's how we report. I've always reported to our institutional LPs, and in some of our partnerships, we're more part of a syndicate where the sponsor partner is doing more of the reporting. And I think we seek those same elements, and they're, can be elusive actually. So those are certainly best practices.
I didn't prep you guys for this question. The point of at the portfolio company level, is there advice you'd have for a sponsor for tools that are helpful in collecting and reporting that data out consistently? This is not an area Juniper Square focuses on, so it's more like if you have advice in the room, because I know it's
Juniper Square is great. I have no idea if Juniper Square is great or not. I don't we're kind of old school, so I think there's a lot of great tools, and even with our portfolio companies, which is maybe the question you asked, maybe it's not, we still find that there's a fair amount of work with each new investment to figure out the right KPIs and what we want to track. And we still do most of that work in Excel. At Tuckerman, just again, we have a system for reporting up to our LPs, which is unfortunately also Excel based. So it's subject to, bugs here and there, but it works. It's worked for 20 years and we make very few errors, thankfully. But, there's probably better systems out there. It's just a learning curve question.
Yeah, and there's not a unified system we use across the portfolio. The other challenge is our portfolio is pretty diverse by industries. And so not all the ERP systems are the same. And I'm sure there's probably a resource or a tool out there, but none that we've ever demoed or tried that we felt fit our needs. So unfortunately, we're doing manual Excel stuff.
I mean, data is the wave of the future. It's already here, mass amounts of data. I think a lot of times, especially depending on the company that you're investing in, if it was, the first time that entrepreneurs are having outside capital come in a meaningful way, they're really not used to the reporting that we require and demand. And you have to understand that. And there's a lot of hand-holding on that side with the portfolio companies to make sure that they understand that, we're fiduciaries as well. We're not where the buck stops. So being able to report on a timely manner takes a lot of time. I'm sure you find that.
For your respective businesses, this touches a little bit on, probably how you aim to differentiate yourselves to investors. But as you look at your business and how it's evolved, where have you become more efficient, whether it be in deal sourcing, it could be hiring, it could be reporting, so that you've been able to spend less time on kind of lower value activity and be the best kind of firms that you can be?
I'll jump in first. Our business model is not a little different, but we find the reason that we have invested, and we go out and talk to our investors who are institutional, medium and large institutional investors, particularly new ones, they're sort of like, why are you investing with these independent sponsors? And one of the reasons is that at the origination level in the small market, it brings a lot of that channel, this community brings a ton of efficiency to what is otherwise a really messy, inefficient, often broken marketplace. And we think that's attractive. And so sort of outsourcing the front end of the deal work to high quality partners makes a ton of sense and allows us to have, just a handful of investment professionals, but to see a very large number of opportunities through the funnel. So that's certainly the most efficient part of our business. There's not a lot of efficiencies at our view in small market investing after that. Like it's just, you got to do the work. So that's my answer for us.
Yeah, I mean, I think that's well said by Nick. And prior to Broadtree actually managed a family office and we were quite active in the independent sponsor space. And so we were always looking for optionality. And because the market is inefficient down in the space, it is messy, like being able to identify relationships that will give you high optionality, give you deal flow, like that, I think is definitely a valuable asset.
I want to react to that because I think that I totally agree. The business is all about optionality. And I think something that this is, I think, the other panel that's going on now, maybe, but something that's we've valued at Tuckerman over a couple decades back in this is the option to get the call next time, not the option to hold this deal. So I think it's an important nuance because I do think there's a lot of new, and again, perhaps they're on the other side, but new capital providers to the space who don't quite get that yet. And it's different than when you're running your own deal, when you're kind of like stepping into somebody else's deal. And so if you value the call next time and being on the short list, you're going to behave differently. And yeah, you're going to miss some things because you're going to say no too quickly. But that allows you, we found over time, to build a pretty interesting option set for people to keep calling you. Anyway, just on the topic of like building options.
And on our side of that, what we want in, you know, the reciprocal of that is that you respond thoughtfully and fairly quickly. The more color you get, then the more sophisticated you are and able to filter and make that next phone call. Oh, this didn't work because of these reasons, but you know, this source of capital is super interested in this kind of deal. So being able to maintain that flow.
Yeah. For us, it's like we want all, I don't know if you guys in the audience who are independent sponsors or who's out here, but we want all the independent sponsors in the world to be super successful. So if we can help them do that, like we're on the very small set that we're going to do, that's great. We're going to work hard to achieve that. And if we're not going to be the right ones, then we want them to be successful with others. So it's that thoughtful feedback. I don't think we can really like presume that we're going to push someone's thinking on a deal, but we might be able to introduce them to another partner for whom the deal is a better fit, or you know, what have you. So that those are easy, you know, easy things to do to build that option set.
Any questions from anyone on the audience? All right, another question I didn't fully prepare you guys for, but if I were to ask you to think in the next 12 to 24 months, what will be different about your firm, or what do you hope will be different about how you're operating, the space you're in, the types of deals you're looking at? Could be sort of a wide spectrum, but what do you think will be different a year or 2 years from now than today?
I mean, for us, it's just being able to be prepared for the unknown, right? We launched right before COVID, didn't have an office for the first 18 months, have learned how to use technology to communicate more effectively within our firm and within the target companies or the portfolio companies. You know, it used to be that for every meeting with the CEO, you had to be in person. People have evolved. Now looking at the macro world, I mean, who knows where capital is going to be? The cost of capital is obviously changing month to month. So I think being able to be nimble, reactive, you know, talking about 6-month-old data, the world just seems to be moving so rapidly that I think you need to be, sometimes you can't be so emotionally invested that you get stuck in where you are.
I mean, I guess to answer your question very literally, we have a couple of job recs out and we're working on a couple of deals. So we'd hope that a few of those come through. But I think bigger picture, thematically, like we're big believers in continuous improvement. So we're always trying to refine our processes, always trying to improve our templates, the way we think about things. And so like, that's kind of what I say we strive towards in the next 12 to 18 months. And I'm not a macroeconomist, so I'm not going to prognosticate on that either.
Yeah, we're pretty prideful around doing the same thing we've been doing for 2 decades. So we are innovating how we do that. I think for Tuckerman, we love the channel that we invest in. The channel's changing and growing, which is great. We started life with a very narrow definition of the deal that we would do, and and that stuck for the first 10 years. And over the last 10 years, as I joined the firm 12 years ago and sort of stepped in to lead the firm 3 or 4 years ago, I've sort of pushed to sort of broaden the barn doors carefully over that time. So I'm hopeful that continues because there's a lot of really interesting deals. And so we're very thoughtful about what the attributes of a deal are that we want to pursue and how those have been consistent for us. It's a lot about value, entry points, and certain economic profiles and business models that are differentiated, but those are pretty broad criteria. So I'm hopeful we can, continue to broaden out, maybe do a distribution deal or I don't know, some different business model that we haven't invested in historically, but that fits the pattern where we've been successful for 20 years.
Yeah, the only other thing I'd add is we love this part of the market, and we have full conviction that this is the best place to generate outsized returns. And so we want to actually stay in this smaller segment of the market, and we like the model we have. And I actually think that's unique. I mean, I guess it'd be interesting to see data if we surveyed all of the independent sponsors in the landscape, like what are your 5 and 10 year goals? But I think a lot of folks are looking to do, eventually raise the fund and then raise a bigger fund and a bigger fund. And we like this part of the market and we like it and we want to stay here.
One thing that is, had you asked my 2 partners who founded the firm 10 years ago, how do you feel about, use your term, buy and build platform investing? They would have said, oh, it's easy to make that make sense on paper, but it's really hard in practice. We just see a lot of risk in that. And my view on that is completely, I agree it's hard to do in practice. There's a lot of work involved, but we've had some real success, as have many, with buy and build platform deals that thoughtfully executed with led by our partners. And so I'm sort of hopeful that over the next 2 or 3 years, we can take one of those deals and sort of have a breakout deal where, you're set, we buy $3 and $5 and $6 million EBITDA companies, but sometimes we sold and we've gotten up to 15, but I'd like to have one of these go to just keep rolling, go to 30 or 40 or 50. I think that would be cool. It's happening. Like we have friends who are doing that. And I think that's an interesting, again, there's a lot of work involved in the consolidation strategies, but I think it's a doable goal for us.
Any other questions, or else one last quick question? I think we've got 2 minutes. Given you guys are established and you have, successful careers already in this space, and there's people in this crowd who are earlier on in their careers, what's a 10-second piece of advice you would give your younger self growing in a career in this space right now?
Always learn. Break your presumptions around what you think is right and wrong, and test them all the time.
I would say be patient. I think sometimes people get caught up in when you get that first deal done, wanting, everything out of it. And it's okay if you don't get the economics you might have envisioned. Do a good job. You'll have a deal 2, you'll have deal 3, you'll have deal 5. I would say patience is one.
That's actually really interesting, because I think the younger, again, I don't know who's in the audience here, but some of the younger sponsors, it's becoming much easier to hang a shingle. And so some of the folks who are relatively earlier in their career are the most impatient to get the, outlier terms on the partnership. And it's sort of that the folks who have been through the wars are kind of we know that it's the partnership that matters. It's not the incremental sort of 2 points of carry or whatever. So I think that's a really good point. It's, 23% of 0 is still 0 versus 20% of, some good outcome. And a lot of those outcomes can be driven by sort of how you construct the partnership and getting the right people around the table, whatever the roles and responsibilities are of those people.
My advice would be curious, and life is not linear. You think that things are going to go a certain way and almost never do. So that goes along with that.
Awesome. Well, thank you very much, Bill. And thank you, everyone. We'll be on to the next one.
Thanks.